Hey everybody, Smart Silver Stacker here. So if you've been watching the silver market today, you have probably noticed that there is a big spike up in the price. The time I'm recording this video, the price of silver is about $24.10. So not quite the highs of the spike up that we had earlier. That's given up a little bit of its gains, but still very much in the green, over 24 bucks for the first time in a while. And why is silver, why are markets across the board spiking up like this? Well, the inflation numbers for November were released earlier today, and they came in weaker than expected, or cooler than expected, you might say. It was anticipated that there would be a 0.3% increase in November with a 7.3% year-over-year CPI, and what we ended up getting was a 0.1% increase with a 7.1% year-over-year number. So inflation is cooler, and that means markets are spiking up. What gives? Why would that be the case? You would think lower inflation and you would see falling commodity prices. But the rationale here is that if inflation is cooling, that means that the Federal Reserve will be able to return to a policy of easy money sooner, leading to more inflation. And that's why assets are catching a bid. And this is some kind of twisted, strange logic. It's the kind of logic and kind of price action you would only see in the kind of centrally planned, central bank governed economy that we have at the moment. And really, this move just reveals to us how fundamentally broken these markets are and how the only thing driving prices in today's market is the Federal Reserve. That's the only thing driving this price action. It's the Federal Reserve and, more importantly, the market's anticipation of what the Fed is going to do next. Now, tomorrow we've got the FOMC meeting from the Fed. They're going to make their announcement as far as what they're going to do with rates. The market is expecting a 50 basis point hike. I suspect that, especially in the context of today's lower than expected CPI number, that is what we are going to get. And a 50 basis point rate hike is probably already largely priced in, so I don't expect there to be some kind of a huge reaction in markets to that announcement. But we've got to keep in mind here what's going on with inflation. I mean, markets seem jubilant that inflation is lower than expected, but inflation still moved higher in November. It moved up by 0.1%. So it's not like inflation is dropping, or prices are dropping. We're not getting deflation. We're getting what you refer to as disinflation. So this is still inflation. However, it's inflation at a decreasing pace. And somehow this means good news for the market. And 1 or 2 months of slowing inflation is not an indication that the Federal Reserve's policy of rate hikes have beaten the inflation monster. I mean, far, far from it. Just like anything else, inflation doesn't move up in a straight line. In a market in which inflation is moving higher, it's going to have ebbs and flows. And I believe that's what we're seeing right now. And, one of the biggest contributors to a falling inflation number this time around was lower energy prices. And of course, much of that is predicated upon the release of petroleum from the Strategic Petroleum Reserve, because this is November's number. So they were releasing many, many millions of barrels of oil from the SPR throughout that month. And that is part of why we have these lower energy prices. And that's the major contributor to why inflation is lower. It's got nothing to do with the Fed being successful with its policy of rate hikes. I mean, I do believe that the Fed is headed towards a pivot sooner or later, but I don't believe that inflation is going to be dropping anytime soon. A slowdown in the rate of inflation doesn't mean that there's not a lot more of it baked into the cake moving forward. In fact, just look at the federal budget deficit for last month. Last month, the federal budget deficit hit $249 billion, almost $250 billion worth of deficit spending in 1 month alone. So the Fed making these little twiddling manipulations to the interest rates in the face of that kind of government deficit spending, that is like a drop in the ocean when it comes to changing the rate of inflation. I mean, we have got some of the most highly inflationary fiscal policy in the history of this country going on at this moment. The debt to GDP ratio is out of control. It's the highest level that it's been at since the end of World War II. And, that was at the end of the war. So at that point, spending could be brought down and it could be gotten back under control. But we are putting the pedal to the metal in terms of government spending right now. interest rates are not high enough to fight inflation. We still have negative real rates. And this market euphoria in the face of these lower than expected inflation numbers is just a sign of the complete manipulation and the fact that we have no real price setting mechanism left in these markets. Now, is the Fed going to return to easy money? Yeah, I think so. I think sooner or later they're going to be forced to. In fact, sooner or later, I think that people will be begging the Federal Reserve not only to slow down the pace of their rate hikes, but also to be slashing rates. And not only that, but to be buying assets on the open market like they were doing with quantitative easing for years. And that is what I think 2023 is going to bring at one point or another, probably sooner rather than later. And when it does happen, it will be because everybody is begging for it, because we haven't even begun to see the real economic pain from this recession which we are in. I mean, there's going to be massive layoffs here at some point. Inflation is going to continue to rise. I mean, anybody who's been to the grocery store recently, I think, has a pretty clear understanding that inflation isn't going anywhere. And you got to remember, all of this inflation is cumulative. You know, the prices are just moving up at a slower pace, but they're already at a very elevated level, and they're going to continue to move higher. Consumers are going to continue to get squeezed. So, you know, there's a lot of things coming in 2023. One of the things is a central bank digital currency. We've already heard quite a bit about that. And I would not be surprised if at some point in 2023 things get so bad that, you know, the conversion to a CBDC takes place, and the way that they will entice people to do that is through bailouts. You know, it's going to be through more stimulus checks. Maybe you'll have to sign up for the CBDC to get a stimulus check, and that'll be why everybody will be begging for it. Just like everybody is going to be begging for Fed intervention, everybody's going to be begging for the bailouts again. And it'll be bipartisan, just like it was last time. Neither party is going to endorse any kind of fiscal conservatism in the face of this economic crisis, because that will be a hugely politically unpopular position to take. And so, you know, we're going to see a lot more bailouts. We're going to see a lot more money creation. We're going to see a lot more deficit spending moving forward. And you know, I think markets are getting it right, bidding gold and silver higher today. But, you know, I think it's for the wrong reason. I think it's because they think inflation somehow is going to let the Fed get back to the policy of easy money. But inflation isn't going anywhere, but the Fed is going to be getting back to that easy money policy. So I think it's got that part right. And, you know, we'll probably see much higher asset prices across the board. But I do think that gold and silver are going to disproportionately move up relative to other assets, whether it be crude oil, stocks, Bitcoin, any of those things. Once the general public really gets a grasp on what's happening to the dollar here and what's happening with inflation, the move into gold and silver is going to be absolutely stunning and phenomenal. Now, when's that going to happen? 2023, 2024, 2025? I don't know. My forecast is sometime before 2026. If you've read Strauss and Howe and their book, The Fourth Turning, you know that their forecast is this whole fourth turning situation that we find ourselves in right now will come to a culmination before 2026. So that's sort of the short-term forecast for me, the short-term window, but it could happen much sooner than that, and it may very well be in the months to come as we head into 2023 here. I mean, we're certainly navigating uncharted waters at this point in the global economy with the breakdown of global supply chains, with the heightened geopolitical pressure, with the inflation, which seems to show no signs of abating, regardless of how the markets interpret these numbers. So that's why I'm still stacking, everybody. Hope you are too. Not financial advice, of course. I'm just a guy on YouTube. But let me know what you think in the comments down below. Thanks for watching, everybody. Stay safe and happy stacking. Smart Silver Stacker, out.